In this webinar, we cover FBARs. In this unit, we're going to talk about foreign financial reporting requirements that apply to U.S. taxpayers. The requirements with regards to foreign financial reporting are not in the Internal Revenue Code. This is one of the areas of tax law that's unique because it's not part of Title 26. Title 26 is the Internal Revenue Code. But the Bank Secrecy Act, which is the law that imposes reporting requirements on foreign financial accounts, is in Title 31. These are not income tax provisions. These are disclosure provisions when you have to disclose something to the U.S. government. The Bank Secrecy Act was passed a long time ago. Originally, it was passed in 1970 to fight money laundering in the United States, primarily between banks and casinos. The United States government at that time, this is before the internet, before computers were widely used, any of that. Of course, the requirements have changed since then. Now there's internet, now there's cryptocurrency, now there's people doing wire transfers back and forth, between different countries. In 1970, none of that was actually possible. You couldn't just, click a button on your computer and send money to a foreign country in 10 minutes. Obviously, things have changed, but the rules in the Bank Secrecy Act have now been used by Congress in order to increase foreign financial reporting for taxpayers who are primarily living and working abroad or taxpayers who have assets and bank accounts overseas. The Foreign Account Tax Compliance Act, which is very frequently shortened to just FATCA, is the law that mandates the reporting of foreign financial assets. So if you own foreign financial assets, regardless of whether you live in the United States or outside the United States, this is the law that mandates that type of reporting. The Bank Secrecy Act is an earlier law. The Bank Secrecy Act was passed in 1970, and then FATCA was passed in 2010. The subject of foreign financial reporting is extremely complex, and the IRS continues to issue guidance on how taxpayers and tax professionals should approach this difficult topic. That's a nice way of saying this is like the scariest part of tax law. The penalties are insane with regards to foreign financial reporting. If you miss a single form, the penalties can be tens of thousands of dollars, and in some instances, even hundreds of thousands of dollars for a single missed form that you need to file if the person has foreign financial accounts or foreign assets that need to be reported. Reporting forms. A person who holds a foreign financial account may have a reporting obligation even when the account produces no taxable income, and even if the person does not have an individual income tax filing requirement. I want you to understand this. These requirements for foreign financial reporting are not tied to income tax reporting. You can have a person who has no taxable income whatsoever for the year. They can have zero taxable income and still have to file these forms. Because this is a disclosure requirement, it is not an income tax requirement. These forms are not income tax forms. They are disclosure forms, which is completely different. You're telling the government about the things that you own. That's what it is. For the purposes of foreign financial reporting requirements, a United States person includes U.S. citizens, U.S. nationals, U.S. residents, and U.S. entities. So sometimes you will see in these legal documents, they'll say this person or a United States person. That's not always referring to natural persons. A natural person is a human being. When you hear the term natural person, that's a human. But sometimes you will hear the term person and they're talking about corporations or U.S. entities. Like a U.S. C corporation is also considered a person. It's not a natural person. You and I are natural persons. But a corporation is also considered a person. And in this regard, a corporation would be a United States person if it had to file these specific reporting forms. It also includes non-resident aliens if they elect to be treated as U.S. residents in order to file a joint tax return, which is the big drawback for non-resident aliens or foreign persons that marry U.S. citizens or U.S. residents. If they elect to file a joint tax return with the U.S. person or the U.S. citizen, then they become subject to these foreign financial reporting obligations as well, which is honestly the biggest drawback. Regardless of any kind of tax savings, many times people who are non-residents, especially if they are wealthy themselves or if they are middle class and living and working overseas, they don't want to deal with this. So they won't file jointly with an American spouse in order to avoid having to, be subject to FBAR and FATCA requirements, especially if they don't ever plan to come and live or work in the United States. There are several different forms used for reporting foreign bank accounts, foreign assets, and foreign gifts. These are the FBAR. We're going to talk about that one a lot. The FBAR is also called the Form 114, Report of Foreign Bank and Financial Accounts. On the EA exam and prior exams, they've used the term FBAR and they've also used the actual form number. I think you just need to know that the Form 114 is the FBAR. Most of the time, when you hear about it in the press or when accountants talk about it, they're just going to call it the FBAR. They won't actually call it the Form 114. But I think you need to know that this is the form number for the FBAR. The Form 8938, which is the Statement of Specified Foreign Financial Assets. Schedule B, which is for interest in ordinary dividends, but there's a part at the bottom of the form, Part 3, which is used for disclosure for foreign financial accounts. Form 3520, Annual Return to report transactions with foreign trusts and receipt of certain foreign gifts. This trips a lot of people up, and there are several cases that have gone through the courts recently with regards to this form in particular. Gifts and inheritances are never taxable to the recipient. I mean, this is regardless of whether the gift or the inheritance is coming from a U.S. person, whether it's coming from overseas. It doesn't matter. None of that matters. An inheritance or a gift is never taxable to the person who's actually receiving it. But if you have a gift or an inheritance that's coming from overseas to a U.S. person, then that might have a reporting requirement. Once you get up to a certain threshold, then those gifts or those transfers or those inheritances have to be reported. And there's no tax, but the IRS still wants to know that you have money coming in from overseas, from a foreign person. The Form 5471, which is the information return of U.S. persons with respect to certain foreign corporations. And I'm going to go over all of these briefly. Let's talk about the FBAR first. Let's get this one out of the way. The term FBAR refers to Form 114, Report of Foreign Bank and Financial Accounts. The FBAR is a reporting requirement only. It's not an income tax return, and it does not directly impact tax liability. In 2003, the Department of the U.S. Treasury delegated FBAR enforcement authority to the Internal Revenue Service. The IRS does not process FBAR filings. You do not file FBARs with the Internal Revenue Service. The FBAR is filed directly with the Financial Crimes Enforcement Network. There is no paper form. All of these have to be filed online. There's no paper form. I mean, you can download it to look at it. There's a PDF version you can download and you can kind of fill it out before you actually submit the FBAR. But when you submit the FBAR, it's only an e-filed form. There's no way to mail it in. So you file the FBAR with the FinCEN, not with the IRS. But the IRS is responsible for FBAR enforcement. And both of these entities, both of these departments are under the umbrella of the U.S. Treasury Department. So the IRS and the FinCEN are both under the purview of the U.S. Treasury Department. The U.S. Treasury Department is the big umbrella, and then the FinCEN and the IRS are little umbrellas below the big umbrella. It's a division of the U.S. Treasury Department, and the IRS and the FinCEN work together, basically to combat money laundering. With regards to FBAR filings, the IRS is responsible for investigating possible civil violations, assessing and collecting civil penalties, and issuing administrative rulings. A taxpayer is required to file an FBAR if the person had financial interest in or signature authority over. Just having signature authority over a foreign financial account will trigger an FBAR filing. It doesn't matter if the money in there is yours or not yours. It doesn't matter if it belongs to someone else. It doesn't matter if you're the primary or the secondary on the account. None of that matters. Just having signature authority over a foreign financial account will trigger the FBAR. If the aggregate value of all foreign financial accounts exceeds $10,000 in US dollars at any time during the calendar year, you have to file an FBAR. And this threshold is the same for every filing status. As soon as you get over this $10,000 threshold, and of course you have to convert, right? So if you have a Mexican bank account, you would have to convert the pesos to US dollars in order to figure out if you're close. And once you do get close to $10,000, there's a firm belief with with accountants that, if you're like right around 9,000 in equivalent US dollars, you should file an FBAR just in case. It doesn't take very long, but the penalties are huge if you don't file an FBAR, and you are required to file an FBAR. Records of accounts required to be reported on the FBAR should be kept for 5 years from the due date of the report, which is the year following the calendar year being reported. It's a different records retention period because it's Title 31, it's not Title 26. And if you do get in trouble for not filing an FBAR, the IRS can go back 6 years in order to assess penalties against you. And they will assess them for every single year that the FBAR remains unfiled or was not filed. Example, Jose is a U.S. citizen who has a bank account in Mexico because he traveled there frequently on vacation and also has extended family there. In prior years, the value of his foreign bank account totaled approximately $7,500. So we're talking about in equivalent U.S. dollars. Therefore, Jose did not have an FBAR requirement. In the current year, Jose decides he wants to build a vacation home in Mexico. He transfers $19,000 to his Mexican bank account on January 17th to begin construction on his new residence. He later withdraws all the funds, and his bank account balance is zero on December 31st. He is still required to file an FBAR because the aggregate value of his foreign accounts reached $10,000. However, he is not required to file Form 8938 because the value of his foreign assets is below the reporting threshold for Form 8938. And I'm going to show those to you in a minute. No age limit. With regards to the FBAR, there is no minimum age requirement for filing an FBAR. The requirement includes minor children as well. If a child holds $10,000 in a foreign financial account, even if the account is not earning any revenue whatsoever, the child will be required to file their own FBAR. This is true even if the child would otherwise not have a U.S. filing requirement. If a child cannot file his or her own FBAR for any reason, such as age, the child's parent, guardian, or other legally responsible person must file and sign it for the child. And let me give you an example of this. And if you can believe it, this apparently happens pretty frequently, where you have a child who has, grandparents or parents that are foreign citizens, and the child happens to be a U.S. child. And the grandparents or the parents will gift that child money, put it in a bank account and say, oh, I'm saving for your future college. But the bank account is overseas. And then all of a sudden you have a 2-year-old with an FBAR filing requirement. Apparently it happens pretty often. Example, Billy is 6 years old. He is a U.S. citizen. Billy's grandmother, Anna, is a citizen of Italy. Anna sets up a savings account for her grandson in an Italian bank and deposits 50,000 euros into the account. Anna then names Billy as the co-owner of the account, just in case she dies, right? Grandparents do this all the time. My own dad did this too, and then he told me after the fact. I mean, it wasn't a foreign financial account, thank God. But it was like an account in the United States. I mean, we went to visit him with our kids, and he's like, oh, hey, So I set up bank accounts for all the kids, just in case if I die, they've all got X number of dollars under their name. Like, why wouldn't you tell me this before you did it? You just like walk down to Bank of America and set up bank accounts for all the grandkids. Just, like they do this. Grandparents will do this. It happens all the time. And apparently it's not an issue for a grandparent to just go into a bank and say, here's $10,000, put my grandkid's name on it. So yeah, this is how Americans get in trouble. Children, even. Anna then names Billy as the co-owner of the accounts. Using current currency conversion rates, the account balance is worth approximately $56,300 US. Billy is required to file an FBAR to report the existence and the value of the account, even if he does not withdraw the funds or personally receive any of the proceeds from the account. FBAR due date. So the FBAR due date is a little bit unique. It seems like it's the same due date as regular tax returns, but technically it's not. The FBAR due date is April 15th of the year following the year in which the account holder meets the $10,000 threshold. So if you had $10,000 in a foreign bank account last year, then you have to file an FBAR by April 15th, technically. However, there is an automatic extension to October 15th in order to file the FBAR. October 15th. There's not necessarily any kind of extended due date if it's a Sunday or holiday or anything else like that. Remember, this is the FinCEN. This is not the IRS. So April 15th is the actual due date. October 15th is the extended due date. There's an automatic extension in order to file the FBAR, but you don't have to file any kind of a form in order to request this extra time. So I guess this is just like a legal fiction where April 15th is the due date, but October 15th is the extended due date, but you don't have to actually request an extension. It's still considered on time if you file it by October 15th. Okay? Whether or not an account produces income does not affect the requirement to file an FBAR. It does not matter if the account is income producing or not. It doesn't matter if the person has zero income for the year and is not working. It doesn't matter if the person is in a coma. Really. Somebody's got to file that FBAR if they want to keep them out of trouble. Also, if the IRS issues a release for extensions of filing to a disaster situation, do not assume that the FBAR filing deadlines are extended as well. It's not the same. If the IRS says, oh, this particular state has an extended due date because of a disaster, you get until May 15th or you get until next year to file. Don't think that that will apply to the FBARs too. FBAR extensions are very rare, even in disaster situations. Spouses and joint accounts. With spouses who have jointly held accounts, they technically, I'm going to say technically, do not need to file separate FBARs if they complete and sign Form 114A, Record of Authorization to Electronically File FBARs, and they have to meet both of these. Okay? All reportable financial accounts of the non-filing spouse are jointly owned with the filing spouse, which means if the couple is married and they only want to file one FBAR instead of two, all reportable financial accounts of the non-filing spouse have to be jointly owned with the filing spouse, which means all of the accounts that they have that they're reporting on the FBAR have to be jointly held. And the filing spouse has to report all accounts jointly owned with the non-filing spouse on a timely filed FBAR. If they can't meet both of these requirements, then both spouses must file separate FBARs, and each spouse must report the entire value of the jointly owned accounts. So when you file an FBAR, remember, an FBAR is just a reporting form. When you file an FBAR, if it's a couple, let's say it's me and my husband, and we have an account together, and there's $100,000 in the account, right? It's a jointly held account. So technically $50,000 of that money is mine, and $50,000 of that money is his. It's a joint account with $100,000 on it. But when you file the FBAR, let's say I'm filing my FBAR, I have to report the value of the account, the full value of the account. So on my FBAR, I would say that the account had $100,000 in it, because that's the value of the account. And then when my husband files his FBAR, he also has to report that foreign financial account too at its full value. I have $100,000 in that account. That's what it has to say on his FBAR too. You wouldn't report like your portion or your half or anything like that if it's a jointly held account. You have to report the entire value of any jointly held accounts. And then, of course, spouses can have their own accounts that are not jointly held. So, for example, let's say I have 2 foreign financial accounts and my husband has 1. Then on my FBAR, I would report my foreign financial accounts if they were just owned in my name, and he would report his foreign financial accounts if they were just in his name. Okay? But if you want to just file one FBAR, and it's a couple, spouses, then all of the accounts have to be jointly held, and all of the accounts have to be reported on a timely filed FBAR by the filing spouse. Now, I'll tell you something. My husband and I actually do have foreign financial accounts, and I did this one year because we do have all of our accounts are jointly held. I did this one year where I just filed one FBAR, and then I had him complete and sign the form 114A. But it gave me the creeps. You know what I mean? It gave me the creeps. Like I felt like, I didn't want to get him in trouble. I didn't want to get myself in trouble. For every subsequent year, I just filed 2 FBARs, right? One for me, one for you. We're going to report the full value of all of our accounts, and that's what we're going to do going forward. I've got one FBAR, you've got one FBAR, and that's how we're going to do it. Because the FBAR makes me nervous. The FBAR makes me nervous. If you make a mistake or you forget to file it or you do it wrong, the penalties are, to the moon! To the moon penalties! Tens of thousands of dollars. And the IRS loves to assess FBAR penalties. Loves it. It's a big moneymaker for the IRS. Now, the e-filing system, remember this is with the FineSend, where you report this. The e-filing system with the FineSend will not allow both spouses' signatures on the same electronic form. So FBARs are not filed jointly. There's no such thing as a joint FBAR. If you have a couple, though, and all of their accounts are jointly held, it's 2 people, right? It's a married couple, and they only want to file one FBAR, then the filing spouse is the one that signs it, and then the other spouse has to sign form 114A and then keep that with their records. Like I said, this made me a little bit nervous the year that I did it, several years ago. And then from there on out, I was like, we're just going to file 2 FBARs from here on out. One for you and one for me. Example, Reuben and Joanna are married and filed joint income tax returns, right? So you could file a joint income tax return. The filing status of your income tax return has no bearing on what's going on with your FBARs, okay? So if you file a separate income tax return or a joint income tax return, that's fine. It doesn't matter what you're filing with the IRS, has no impact on how you file your FBAR. They're completely separate filings. Okay? But if you make a mistake on your income tax return and you make a mistake on your FBAR, then the IRS will come after you for penalties for both, because the IRS is responsible for FBAR enforcement. Okay, so Reuben and Joanna are married. They file jointly. They're both U.S. citizens and they live in the United States. Reuben has a foreign bank account in France, where his parents live. Joanna has a bank account in Portugal, where she also has family. Reuben's account has $6,000 in equivalent U.S. dollars. So his French bank account has the equivalent of 6,000 U.S. dollars in it. Joanna has $14,000 in equivalent U.S. dollars in her foreign accounts, presumably in Portugal. They each own their foreign bank accounts separately. They are not jointly held. Joanna must file an FBAR, but Reuben does not have to file an FBAR. This is true whether they choose to file their income tax returns separately or jointly. She's the only one that has to file an FBAR. because she's got 14,000 equivalent dollars in her Portuguese bank account. And then Ruben only has $6,000 in equivalent US dollars in his French bank account, so he doesn't have to file an FBAR. But on their tax return, they have to mark on the Schedule B that they have a foreign bank account. And I'm going to show you where that is. They have to mark it. They have to say yes or no. This is the website for the Financial Crimes Enforcement Network. I just wanted to show it to you really quick. This is not the IRS website. This is the FineSen. If you scroll to the middle of the page, this is where you would go in order to file an FBAR. Right here is where you would click if you were filing an FBAR for yourself. So this would be an individual person, taxpayer, a private individual that was filing their own FBAR. If you're going to be filing an FBAR on behalf of a client, you have to enroll as a BSA e-filer. So you enroll here in order to actually submit these for clients. And you can do that once you become an enrolled agent. Let's go back to our slides. We're going to talk about FBAR penalties. The Treasury Department reports that FBAR filings have surged in recent years, with current filings exceeding 1 million per year. Over 1 million FBAR filings per year. The consequences of failure to timely file an FBAR can be extremely severe. Both civil penalties and criminal sanctions can be imposed. By law, civil penalties could exceed $10,000 per year, adjusted for inflation, for a non-willful failure to file. This is the penalty for non-willful failure. Non-willful means accidental. You didn't do it on purpose. The IRS can still assess you a $10,000 penalty for non-willful failure. A willful failure could result in the greater of $100,000 or 50% of the balance in an unreported foreign account per year for up to 6 years. Remember I talked about how the record retention requirements for FBARs is different, and that's because the IRS can go back and assess willful penalties against you if they do deem that you didn't file an FBAR and it was a willful failure. They can go back 6 years. This is in addition to criminal penalties if they deem that it was a willful failure. You did it on purpose, or you were trying to hide money, whatever. They suspect you of something. If they suspect you of criminal activity, for example, you really are laundering money, and they discover that, then they can also include criminal penalties, which can include a fine of up to $250,000 and 5 years in prison. This is in addition to the civil penalties that they can assess. The potential penalties for willful failure to file an FBAR are huge. These penalties can include criminal prosecution as well as severe monetary civil penalties. The most common FBAR reporting mistake is simply failing to file, though. Most people are not criminals trying to hide money overseas. Most people are not doing that. But it is pretty common for taxpayers to just fail to file the FBAR because they don't realize that this filing requirement exists. The IRS has issued guidance on penalties for failing to file an FBAR that caps the maximum percentage of the penalty. Example, and this is from an actual case. There's a lot of FBAR cases out there, people. There's a lot of cases out there. Example, Harold Kahn had 2 bank accounts in Switzerland. He failed to report the funds in his foreign bank accounts on the FBAR. The total in both accounts was over $8 million. The U.S. government determined that it was a willful failure to file the FBAR and assessed a willful penalty of $4 million, which was equal to 50% of Harold's aggregate account balances. They were basically trying to take half of everything that he had in those accounts. Harold Kahn died after the penalty was assessed. Shocker, right? He probably had a heart attack because, I mean, this is crazy. He has $8 million in the accounts and the IRS is going to take half. That didn't stop the IRS, his death. His death didn't stop the IRS. The estate of Harold Kahn was forced to litigate. Basically, his 2 sons, this poor guy, he died. I mean, poor guy, he's dead, right? So the stress of this probably killed him. And then the 2 sons were the co-executors of the estate. And then his kids had to deal with the IRS afterwards. the government went after the estate for the penalty, and the penalty was affirmed. So the sons tried to fight this as the executors of the estate, and they lost. And they had to cough up the money, I'm assuming. A Supreme Court case was just decided right at the end of February. This was a huge case, everybody, huge case. For the purposes of the non-willful civil penalty, on February 28, 2023, in a 5-4 decision, the United States Supreme Court ruled that this penalty applies per FBAR report and not for each reportable financial account. What happened in this case is it was a naturalized U.S. citizen. And he had an accountant in the United States, either a CPA or an EA. And he had actually asked that accountant, do I need to file anything specific because I have a business in my home country? And he had bank accounts in his home country. He was reporting all of his income, people. All of his income was properly reported. There was no issue with him laundering money or him doing anything shady or anything. He was completely above board. But he just simply didn't report the existence of these foreign financial accounts. He didn't file the FBAR. And his accountant had told him that he didn't have to, right? Okay. The IRS went after him for non-willful penalties. They deemed that it was non-willful, that he didn't do it on purpose, right? He obviously didn't do it on purpose. He wasn't trying to hide money or anything. He didn't do it on purpose. He just did not file the FBAR. But he had tons of financial accounts overseas. I mean, dozens, because he had businesses in his home country. He was a very wealthy man. And he had multiple businesses, and those businesses had multiple accounts. So what happened is the IRS tried to go after him for $10,000 of non-willful failure for every account that he owned. The penalty ended up being over $2 million. Because it was like, okay, so he had 20 accounts this year, so we're going to assess him $10,000 per account for every single account that he had for every single year that he failed to follow the FBAR. Well, he felt that this was unfair. Yeah, I do too. I felt like it was unfair. And apparently the Supreme Court agreed because they ruled in favor of the taxpayer. So if the taxpayer has a non-willful failure, which means they didn't do it on purpose, and they were reporting all of their income along the way, there was no intent to defraud the government or anything like that, then a non-willful FBAR violation will only be one civil penalty. One civil penalty can be imposed on the taxpayer for the year, regardless of how many foreign accounts they have. So, for example, if I do have 5 foreign bank accounts, but I'm reporting all of my income, I'm not doing anything shady, but I have 5 foreign bank accounts, and I fail to file an FBAR, then the IRS can assess a penalty against me, and they can assess a $10,000 penalty against me. But they can't assess a $10,000 penalty against every single account that I have. Okay? Which would be worse, obviously. So only one civil penalty can be imposed on the taxpayer for the year. Prior to this decision, there was a split in the lower courts about whether the non-willful civil penalty could be imposed per FBAR report or for each reportable foreign account. So there was a split in the courts. And the Supreme Court stepped in and decided in favor of the taxpayer, which I think is great. This is a victory for expats and taxpayers everywhere. Because in this case, the taxpayer had reported all of their income. And he had asked for advice. Supposedly he had a competent tax professional, but a licensed tax professional at least, maybe not a competent one, but they gave him incorrect advice and said, you don't have to file an FBAR, when in fact he did. For FBAR purposes, a foreign financial account is defined as a financial account located outside of the United States. The following accounts are not considered foreign financial accounts. Any foreign financial accounts owned by a governmental entity, foreign financial accounts owned by an international financial institution, foreign financial accounts maintained on a U.S. military banking facility, for example, a banking institution on a U.S. military base. That would not be a foreign financial account. Safe deposit boxes. A safe deposit box at a foreign financial institution is not considered a financial account for tax reporting purposes. So if you have a safe deposit box in a foreign bank, that the box itself is not considered a foreign financial account. However, under FBAR rules, if gold, bullion, or foreign currency is held inside a foreign financial institution, it is subject to FBAR reporting. Okay. So, yeah, technically a safe deposit box at a foreign financial institution is not considered a foreign financial account. But if you put any money into it, then that has to be reported because that money is technically inside of a foreign bank. I mean, maybe a safe deposit box at a foreign financial institution doesn't have to be reported if you only keep like documents in it. You know, you keep your will in there or something like that. But as soon as you put money in that box, then you're probably creating a reporting requirement because the FBAR rules say that if you have currency or gold or bullion held inside a foreign financial institution, then that would be subject to FBAR reporting. And I think that safe deposit boxes are inside of the bank, right? Okay. Specified foreign financial assets do not include gold, bullion, or currency held directly by the taxpayer. And I'm going to give you an example. Joe is a U.S. citizen who lives in Colombia. Joe collects gold and silver coins as a hobby. He keeps the coins in a wall safe inside of his home. He does not trust banks, so he does not have a foreign bank account. He keeps all of his cash inside the wall safe too. Joe does not have an FBAR filing requirement. So he has all of his assets and his money and his gold and everything inside of his house in Colombia, which probably is not a very safe thing to do. But if he does it this way, then he doesn't have to file an FBAR because all of those assets are being held directly in his house. The next webinar covers foreign gifts and bequests. In this webinar, we cover foreign gifts and bequests. Foreign gifts and bequests. U.S. individuals who receive large gifts or bequests from certain foreign persons may be required to file Form 3520, Annual Return to Report Transactions with Foreign Trusts and Receipt of Certain Foreign Gifts. Form 3520 is due at the same time as a U.S. person's income tax return, including extensions, but it is filed separately from the income tax return. It's considered separate. It has its own like signature area and jurat. You file it separately from the income tax return, and that's true of regular gift tax returns as well. In one of my groups that I belong to, my software group for my professional software, another tax practitioner asked, like, where do I attach the gift tax return? That's the Form 709. And you don't attach the Form 709 anywhere. It's its own filing. It gets sent in by itself. It's not attached to your individual tax return. And that's the same with the Form 3520. It's considered it's a separate filing. And many times people who don't have a filing requirement, they might have to file one of these forms because they're receiving like a foreign bequest or a foreign inheritance. So for example, let's say you have someone who's 65 or 70 and they're just receiving Social Security and they have no other income coming in. They wouldn't have to file an income tax return. But if they receive a large foreign inheritance, like let's say they have a brother or sister that lives overseas and they pass away and then they inherit a huge amount of money from that person, then they might have to file the 3520, the Form 3520, even if they don't have a normal filing requirement for income tax. So this filing requirement is considered separate. A U.S. person must file Form 3520, Annual Return to Report Transactions with Foreign Trusts and Receipt of Certain Foreign Gifts, if the taxpayer receives gifts or bequests valued at more than $100,000 from a non-resident alien individual or a foreign estate. The taxpayer must aggregate gifts from related parties. And I'm going to give you an example of this. Form 3520 is considered an information return, not a tax return. No taxes are assessed on this form because foreign gifts or bequests are not subject to income tax. It's an information return only. There's no place on the form to put income tax or to or to pay it, or you don't send in a check or anything else like that. This is just informational only. Example, Wendy is a U.S. citizen that has many relatives living in Canada. During the year, Wendy received $60,000 from her Canadian grandfather and $52,000 from her Canadian brother. Wendy has to aggregate these gifts. They're related parties. They're closely related gifts. She has to aggregate them. Wendy must report the gifts because the total is more than $100,000 in a single year from related parties. The gifts are not taxable, but she is required to report them on Form 3520. And this is true even if she had no income for the year. She's still got to file this form. Not foreign gifts. A foreign gift to a U.S. person does not include amounts paid for qualified tuition or medical payments made on behalf of a U.S. person. Example, Jason is a U.S. citizen attending college in the United States. His aunt, Francine, is a wealthy citizen of Australia. Francine offers to pay her nephew's tuition. She makes a payment directly to Jason's college. There are no filing requirements for this foreign gift. And it doesn't matter how much the tuition is. He could be going to Stanford. It could be $100,000, $200,000. That's fine. It doesn't matter. In this case, if the aunt makes the payment directly to the college and Jason never receives the money personally, then nothing has to be reported. It's fine. Now, if she were to send him a check and then he were to pay his tuition after that, he were to deposit the check into his bank account and then pay his tuition, then he would have to file the form. But if it's done this way, where his aunt just pays the college directly, then no reporting is required. Example number 2. Gary is a U.S. citizen who lives and works in the United States. Gary's grandmother, Geraldina, is a Portuguese citizen. On January 30th, Geraldina dies and leaves Gary a large inheritance of $250,000. After his grandmother's estate is settled by the executor, Gary receives the inheritance via a wire transfer on June 10th. Gary must file a Form 3520. The funds are not taxable to Gary. This is 100% tax-free to him. But the inheritance must be reported since it is a bequest from a foreign estate over the reporting threshold. The next webinar covers foreign financial assets. In this webinar, we cover foreign financial assets. Foreign financial assets. Now, this is another separate filing. Taxpayers who hold specified foreign financial assets must also file Form 8938, Statement of Specified Foreign Financial Assets, with their tax returns if the amount of their assets exceeds certain thresholds. This is a separate filing requirement in addition to the FBAR filing requirements. Form 8938 requires the taxpayer to provide detailed financial information about their foreign accounts. And this form is a lot more complicated than the FBAR. The FBAR is actually pretty easy. If you have the totals and the information on the bank accounts that you're reporting on the FBAR, assuming a person doesn't have 100 foreign financial accounts or they've got something really complicated going on, if it's just a situation where a person has 1 or 2 foreign financial accounts, they have an account in Mexico or an account in Canada, the FBAR, I feel like, is a pretty easy filing. It's not that complicated. The Form 8938 is a lot more complicated. And most tax accountants that actually do prepare these forms, if you decide to go into international tax reporting, I'll tell you this right now as a little sidebar, you can name your price. The accountants that do these types of tax returns, they're charging $2,000, $3,000, $5,000 for a single tax return. And that's because the professional risk is enormous. I mean, you can have a $10,000 penalty for missing one form, a $100,000 penalty for missing one form. So there's a lot of questions that have to be asked, and all of these forms have to be filled out very thoroughly and well and carefully. So there's a lot of accountants that don't want to take on this kind of professional risk, so they don't. There's not a lot of accountants that do this type of foreign financial reporting. And I'm just talking about it in a very narrow way because I'm telling you what you need to know for the test. There's certificate programs out there where you could take, semester or year-long coursework just on international reporting. And if you decide to go into this, there's a ton of money in it. If you, if you have if you have the stomach for it, or you got to have like a spine of steel in order to do these types of returns. But if you want to do it, the field is wide open. There's tons of work out there and not enough accountants to do these. Form 8938 requires the taxpayer to provide detailed financial information about their foreign accounts. Specified foreign assets include, but this is not an exhaustive list. This is just examples here. Foreign stock or foreign securities if they are not held in a U.S. brokerage account. Like if you purchase foreign stock through like your E-Trade accounts or your Fidelity accounts, those aren't considered foreign financial assets because you're purchasing them through a U.S. financial institution. But if you actually hold foreign stock or foreign securities directly, then those are foreign financial assets that have to be reported. Financial accounts maintained by a foreign financial institution. This would include foreign banks, but the thresholds for the Form 8938 are higher than the FBAR, and I'm going to give those to you in a minute. Foreign pensions or deferred compensation plans, interests in a foreign estate, a partnership interest in a foreign partnership, and any interest in a foreign issued insurance contract or annuity with a cash surrender value. Form 8938 filing thresholds. Now remember the filing threshold for the FBAR is $10,000 in aggregate in foreign financial banking institutions or foreign financial accounts. The 8938 filing thresholds are higher. If the taxpayers are living inside of the United States, if they have a U.S. tax home, and they are unmarried or married filing separate, then they have to file a Form 8938 if the total value of their specified foreign financial assets is more than $50,000 on the last day of the tax year or more than $75,000 at any time during the tax year. What this means is that let's say I have a foreign bank account in Mexico and I want to buy a house. Okay, I have it in Mexico. I want to buy a house. So I transfer money to that bank account. I transfer $100,000 in there. It's only in there for 1 day or 2 days, and then I pay the seller of the house that I want to buy. But the money only went into the account for a few days. I would have to file the Form 8938 as well as the FBAR because the money in that account exceeded these thresholds, even if it was just for a few days. Then I would have a reporting requirement because of that. I'd have to file the Form 8938 as well as the FBAR in that scenario. Married taxpayers filing married filing joint, the total value of specified foreign financial assets is more than $100,000 on the last day of the tax year or more than $150,000 at any time during the tax year. Now, if the taxpayers are living abroad, the thresholds are a lot higher. So if you have unmarried or married filing separate taxpayers, they have to file a Form 8938 if the total value of their specified foreign assets is more than $200,000 on the last day of the tax year or more than $300,000 at any time during the tax year if they live abroad. So a lot higher than up here. So these are the thresholds up here for people that live inside the U.S. or in the U.S. And this bottom threshold is for people who live abroad, who live outside the United States. For married taxpayers filing jointly, for joint filers, the value of their specified foreign assets is more than $400,000 on the last day of the tax year or more than $600,000 at any time during the year. And then they would have to file the Form 8938. Note, if a taxpayer is not required to file an income tax return for the year, he or she does not need to file Form 8938, even if the value of their specified foreign assets is greater than one of the reporting thresholds. This would be really unusual for this to happen, but let's say I live overseas, okay, and I won the lottery a couple years back, and I just have $600,000 sitting in a bank account, but it's not earning any interest. I don't have a job. I have no revenues coming in whatsoever from anywhere. Then I wouldn't be required to file a tax return if I had no income, zero. In that case, if you don't have to file an income tax return for the year and you have no filing requirement, then you don't have to file a tax return just to file this form. But in that case, in the scenario that I gave you, I would still have to file the FBAR. The FBAR filing would be required, whether I had any income or not. Example, Edward, a U.S. citizen, purchased securities of a French corporation through a professional securities brokerage firm located in New York. So he used a domestic firm to purchase foreign securities. Edward is not required to report these securities because he purchased the securities through a brokerage institution located in the United States. Example number 2. Larry is a U.S. citizen who lives in Costa Rica. He does not work or have any taxable income because he inherited a large sum of money from his grandparents 10 years ago, and he lives off of his inheritance. He's living the dream, right? Doesn't work, doesn't have a job. He's just enjoying Costa Rica, living on the beach. He has $500,000 in a checking account at a Costa Rican bank. The bank account does not generate any interest, and he has no other income, so he does not have a U.S. filing requirement. He only needs to file the FBAR to report the foreign bank account. He does not need to file a Form 1040 or a Form 8938. He still has to file the FBAR. But he doesn't have to file an individual tax return or the Form 8938 because he has no income for the year whatsoever. No filing requirement otherwise. The next webinar covers foreign real estate and currency. In this video, we cover foreign real estate and currency. Foreign real estate and currency. Foreign real estate is not a specified foreign financial asset. Therefore, a personal residence or even a rental property in a foreign country does not have to be reported as a foreign financial asset unless the property is being held by a foreign entity. And in fact, many times Americans who purchase property overseas will do it through a foreign entity. They'll do it through a foreign trust or a foreign corporation. It's usually recommended to them, by a financial advisor or by their realtor or whoever they're working with overseas in order to purchase that property. The problem is that if you actually do purchase property through a foreign entity, then it does become a foreign financial asset. But if you hold the property personally, just in your name and not through a foreign entity like a foreign trust, then it's not considered a foreign financial asset if you just own it outright. And this is true even if it's business property like a rental. Like you have a foreign Airbnb or a condo that you rent in a foreign country. If you own it outright in your name, then that's not a foreign financial asset. Directly held tangible assets such as art, gold, antiques, jewelry, cars, and other collectibles are also not specified foreign financial assets. Foreign currency is also not a specified foreign financial asset if it is directly held by the taxpayer and not held in a financial institution. So if you just have like stacks of cash underneath your mattress or in your safe at home, along with gold coins or whatever, that doesn't have to be reported. Those are not foreign financial assets if you hold those assets directly and not inside a bank. Example, Darius is a U.S. expat living and working in Mexico. At the end of the year, Darius has $385,000 in a Mexican bank account because he is saving up money to purchase a condo in Cancun. Darius must file an FBAR as well as a Form 8938 because this is above the filing threshold for his filing status. He's single, he's not married. And even if he's living and working overseas, he's gone above the filing threshold for the 8938. And then, of course, he also has to file the FBAR. Phineas is a U.S. citizen living and working in Canada. He owns a house in Canada and also has some very valuable artwork. The value of the house is $370,000 and the value of the artwork is $125,000. He owns the house and artwork outright in his own name. He is not required to report the value of these assets on Form 8938. He also has a foreign bank account in Canada with the equivalent of $9,000 US. His foreign bank account balance has never exceeded $10,000, so he does not have to file an FBAR either. So he doesn't have to report any of these assets at all, and he also doesn't have to file an FBAR because his Canadian bank account has never gone above $9,000 US dollars equivalent. The next webinar covers Schedule B, Part 3, and Form 5471. In this webinar, we cover Schedule B, Part 3, and Form 5471. Schedule B, Part 3. So Schedule B is generally used to report interest and dividends. However, the last part of Schedule B, right at the bottom, Part 3, take a look at it so you can see it. It's used by taxpayers who have financial accounts in foreign countries. This is why you have to ask everyone, every single client, do you have cryptocurrency or do you own cryptocurrency? That's question number 1. And do you have a foreign financial account? That's question number 2. You've got to ask everyone. This section of the form is where the taxpayer must disclose any foreign bank or investment accounts and whether or not the taxpayer received any distributions from a foreign trust. On Part 3, Schedule B, a taxpayer must check yes or no to the question of whether he or she at any time during the year had a financial interest or signature authority over a financial account. Note, if a taxpayer does not have a filing requirement, they are not required to file a tax return merely to report their foreign financial accounts on Schedule B. So if the person doesn't have to file a tax return, they don't have to file a tax return just to make this kind of a disclosure on Schedule B. But if they do file a tax return and they do have a foreign financial account, then they have to check yes on the Schedule B. And this is true even if they don't have any interest or dividends to report. Schedule B is usually used to report interest and dividends, but that Part 3 at the bottom is mandatory. If a person has a foreign financial account, they have to say yes or no. A taxpayer who had a financial interest in a foreign account during the year should check the yes box, even if he or she is not required to file an FBAR. There is no dollar threshold to report foreign accounts on Schedule B, even if you don't have to file an FBAR. This is true. So let's say I have a foreign financial account and I've got $15 in it. I've got a little tiny bank account in Mexico. It's got 20 bucks in it or 100 bucks in it. That's all it's got. I don't have to file an FBAR. But if I file my tax return, I have to check yes on the Schedule B that I have a foreign financial account. And that's true even if it's not my money. That's true even if it's just like a joint account and it's not my money, or if I just have signature authority over that account. Let's say it's my parents' account or my in-laws' account, and I just have signature authority over that account and it's not my money. I would still have to report it on Schedule B. I'd have to check yes. Even if the taxpayer does not have an FBAR reporting requirement, the yes box must be checked if the taxpayer has any financial interest in or signature authority over a foreign account. Form 5471. When a U.S. taxpayer is an officer, director, or shareholder, merely holding shares in a foreign entity will trigger this filing requirement. An officer, director, or shareholder in a foreign corporation, they may have an IRS reporting requirement. Form 5471 is typically used to report ownership of a foreign corporation that exceeds a 10% threshold. The Form 5471 is generally filed with a taxpayer's individual return. Even if a person is not required to file a return, for example, if their income is below the filing threshold, the Form 5471 may still be required. So it's not like the Schedule B, where if you don't have to file a tax return, you wouldn't necessarily have to file a Schedule B just to report the existence of a foreign financial account. But the Form 5471 is different. Even if you don't have to file a tax return, you might still have to file a Form 5471. The requirement to file Form 5471 is not based on whether the business generated any income. That's irrelevant. Form 5471 is an information return, not a tax return. The penalties for non-filing are severe. Each failure to file a required Form 5471 can result in a $10,000 penalty per form. Okay, and let me give you an example. Generally, people get in trouble with non-filing on the 5471 when they inherit assets from a foreign shareholder that might be a family member who's living and working overseas, and they've invested in, a foreign company, or they're an officer of a foreign company, and then they die, and then you have a U.S. citizen, an heir or a beneficiary that inherits those assets, and they don't know quite what to do, or they don't get competent financial advice, because there's not very many accountants really that know about this filing requirement and even know how to file these forms. So that's how U.S. citizens get in trouble, generally, with this filing requirement. Example, Brianna is a 15% shareholder in 3 separate foreign corporations. She inherited the stock when her German grandfather died 2 years ago. So see, her grandfather was German. He owned stock in foreign corporations. Maybe she's young. She doesn't realize that there's a filing requirement. She fails to seek proper legal advice, and as a result, she doesn't file her returns on time, including the required Forms 5471 for her ownership in the foreign corporations. She later receives a notice from the IRS. Since she did not have any reasonable cause for her failure to file, she is assessed a penalty of $30,000, and this is $10,000 for each entity that she failed to report on the Form 5471. So she inherited stock in 3 separate corporations from her deceased German grandfather. That would be 3 separate filings. And those would all have to go in on the Form 5471. 3 separate reporting requirements, 1 for each corporation. So the IRS will assess a $10,000 penalty for each entity that she's a shareholder in that she failed to report. So a $30,000 penalty. And it's not an income tax filing requirement, which means that even if these corporations lost money and she had no money coming in whatsoever from these corporations, she would still have to file these forms. Now, the last slide is this handy dandy chart that I put together for you with the differences between the FBAR and the Form 8938, when you have to file one and when you have to file the other. I think that you should become familiar with the reporting requirements for both of these forms for the test. That's the end. Next unit is Unit 18, which covers estate and gift taxes.